Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending September 23rd, 2022. The market indexes, gold and oil, were all lower in a second tough week in a row. Fears of a recession caused by the rate hikes brought all the markets lower. Friday especially, the hawkish messaging from the US Central Bank and the likelihood of sizable interest rate hikes fueled the panic in equities and bonds on Friday. Oil is below $80 per barrel for the first time since January. The stock markets are back down to the June lows. The big news for Canada was that the Canadian Consumer Price Index came out on Tuesday. The CPI for August year over year, the actual was 7% increases. The expected, however, was higher at 7.3%, and the previous month's year over year was 7.6%. So that was good news. The month over month CPI for August, the actual was negative 0.3%. The expected was 0.1%. And the previous month's was a positive 0.1%. So again, this was good news, better than expected and better than the previous month. The problem happened with the core CPI when you strip out the volatile food and energy. The actual was 5.7%. The expected, however, was 5.5%. And the previous month's was 6%. So we were better than the previous month, but worse than expected. And the markets didn't like the core CPI and went down, even though if inflation continues to trend lower and or the economy gets into a recession, the central banks may cut rates in 2023, which the markets would love. The central banks are using trailing indicators like CPI to judge their rate hikes, where the rate hikes take at least 6, if not 12 or 18 months to work their way through the economy. Turning to Canadian real estate, the sector sales were down for the sixth straight month in August, but prices are still above a year ago's level. The price decrease may be halfway done. A bottom may be around the spring of 2023. Experts are expecting the Bank of Canada to increase interest rates by 0.75% in total from this point to end at 4%. Others think, because of the Canadians' higher sensitivity to interest rates due to the Canadians' higher debt levels, the Bank of Canada may stop earlier at 3.75% and pivot in 2023 to reducing their rate before the US Central Bank does, as the Canadian economy slows down faster than the US because Canadians will have to stop spending. Canadian mortgages are also the 5-year term rather than the 30-year term that the US has. Canadians will have to refinance to higher rates earlier. The U.S. Central Bank raised interest rates by 0.75% in the U.S. on Wednesday to 3.25% rate. The Fed also says it expects the interest rate to rise to 4.6% by next year, up from 3.9% it had projected in June, according to the FOMC officials' projections. The U.S. Central Bank wants to crush inflation, and to that end, they are above neutral rates in mild restrictive territory. They're ignoring some positive signs of price easing and keeping the pressure on the economy. The central banks are willing to risk a recession to get inflation back to around 2% and maintain price stability. Higher for longer is the new normal. Powell signaled even more aggressive hikes in the future than expected by investors, intending to knock down markets, which would cause people to feel less rich. The continued hawkishness in the US drove the markets lower on Wednesday in the US and in Canada. The expectation in Canada is that our central bank will take similar steps. Bank of Canada is making their next decision in October, and they get to see one more inflation and one more jobs data point before then. Also, Canadian inflation is lower than the US. The odds of a soft landing in the economy have diminished, according to Chairman Powell himself. There are overall market worries about profit margins coming down in Q3, which would cause share prices to come down. Then again, there are similar worries before every quarter. A 2-year and a 10-year US yield curve inversion of 50 basis points plus has occurred, the most in 22 years, and this is a possible recession indicator. On the plus side, the 2-year government bond is now a nice alternative to some stocks. Turning to international news, the World Bank has warned of a 2023 worldwide recession. While there is an overall trend in all the world markets, diversification is important and not all the asset classes behave the same. Choose what works for you in your risk tolerance, time frame, and return needs. A strong US dollar is making things more expensive around the world since many things, including commodities, are priced in US dollars. The US is thereby exporting their inflation. Historically, we're heading into the strongest seasonal period for the markets. September is a bad month, October is much better. Remember that markets historically have recovered from 100% of the bear markets and have gone upwards. Companies reporting next week are Canada's former darling BlackBerry, which reports Tuesday. Nike and Carnival report on Thursday, showing us the health of the US consumer. Looking at economic events next week, the US oil inventories are on Wednesday, possibly affecting the price of oil. Thursday is the US and Canadian GDP, and the Fed's preferred inflation reading is on Friday. The 1 million per day withdrawals from the US Strategic Oil Reserve are also stopping at the end of next week, and a new tropical system could threaten the Gulf Coast oil industry in the US. Both of these should be seen as positives for the price of oil. That concludes my thoughts for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.